How to prepare financials for due diligence. First, I'll give you the full list of financial documents that buyers are going to request and the ones that typically trip up sellers. Then I'm going to explain why your financials need to be consistent and airtight before you ever allow buyers to see them. Finally, I'll tell you the one thing that you need to have ready to go before you list, to list that you're a serious, well-prepared seller. By the end of this video, you will know how to prepare a financial due diligence package that shortens the process and preserves deal value. So why do well-prepared financial due diligence documents shorten the sales process? Every question that a buyer will ask elongates the sales process. If your financials are clean, well-organized, consistent throughout, this process gets shortened and the buyer gains more confidence in you as a seller. Conversely, messy financials signify risk, and you're gonna have more questions and it will elongate the process and potentially hurt your deal value. If you are preparing these documents for the first time when you're requested by a buyer, there will be holes and there will be inconsistencies throughout, and you will lose deal value. What are the standard items within a financial due diligence request list? It's 3 to 5 years of tax statements, 3 to 5 years of tax returns, personal and business, profit and loss statements, balance sheets, cash flow statements, and bank statements, credit card statements as well. Other common request items: accounts receivable schedules, accounts payable schedules, debt schedules, capital expenditure schedules, payroll summaries, revenue by customer, revenue by product or service lines. Have all these organized and ready to go before you go to market. It is important to have all your books reconciled before you go to market. Revenue on your P&L, profit and loss statement, should match bank deposits. Most small businesses are on a cash basis, so revenue will match bank deposits. Assets on your balance sheet should match reality. Cash flow statements should tie directly to your bank statements. If these don't tie, either to supporting documents or to each other, buyers will ask a lot of questions and will lose a lot of confidence in your business. This is considered basic blocking and tackling, but you'd be surprised at how many sellers are not ready for this step. And to emphasize, consistency matters. Everything needs to match throughout. All of the financial statements and supporting documents need to be consistent. The next step is to normalize your earnings. So what does this mean? In every small, medium-sized business, there will be one-time expenses, one-time charges, or expenses that won't be recurring after the sale gets completed. As a seller, you can document all of this and add it back to your net income for an improved net income metric. However, there needs to be clear explanations for each one of the add backs, and you need to have documents to support your reasoning. Common add backs will include above market owner compensation. A lot of times small business owners will pay themselves more than what they would pay someone to replace them. If a small business owner runs their personal expenses through the business, those can be added back. And then non-recurring consulting fees. A lot of times as a business owner gets ready to sell, they will get consultants and advisors to come in and we'll have to start paying them. Those fees will not recur after a sale gets completed. Each add back needs to be defensible. The buyer's quality of earnings team will challenge every single one of them. However, if you have supporting documents and clear methodologies and good reasoning, you should be fine on keeping all of those add backs. So how do you pass all these documents over? You create a virtual data room. I would advise using a professional VDR as you go throughout this process. These professional VDRs will have access controls, change management, activity tracking, and watermarking built into their platform. Having this ready can truly signal professionalism and a well-prepared seller. So many people will ask which VDRs are best. You can use a Google Workspace, but it doesn't have some of the protections and some of the niceties like watermarking and activity tracking. There are plenty of options out there, and I would advise as you work with your M&A advisor to ask what their best preferences are. So what are some common financial issues that kill deals, and how can we proactively prevent those? Common deal killers are unfiled or amended tax returns, revenue that's recorded on a cash versus accrual basis and is very inconsistent, large unexplained journal entries, commingled business and personal funds running through the business, off-book revenue or expenses, related party transactions that don't have arm's length terms. Each of these are fixable, but only if you address them quickly. and before a buyer finds them. So what can you do today to start this process? Pull 3 years of these commonly requested documents and identify gaps that you currently have. Work with your CPA to reconcile and fix anything that doesn't tie out and is not consistent. Start building a schedule of add backs and include the documentation. You can get a head start on the virtual data room, but I don't know if I would pay for the whole service until you're getting ready to list. Some of these items are the exact type of things that can get uncovered during a due diligence review and can truly kill deal value. I put together a full breakdown of how to deal with these issues and how to prevent them from ever going in front of a buyer. The reason why I want you to watch that breakdown video is so that you can walk into this process with leverage instead of losing it. Go ahead and watch it next. I'll link it here.